Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us they seem to be running out of steam with the transports in trouble, and there have been at least 5 so-called Hindenburg events recently. Ross takes a look at gold, crude, and the U.S. and Canadian dollars. He also has a special offer for our listeners. Jim Rickards, founder of the James Rickards Project, tells us about his new book, Money, GTP, and how AI could accelerate the next stock market crash. He looks into AI privacy issues and where the safest places to store wealth could be. He's also very bullish on gold. Longtime trader Victor Adair joins us from Vancouver Island to discuss whether the stock markets have topped out, especially when it comes to big cap tech, and whether the philosophy of buying the dip will work anymore. Victor also looks at gold, the U.S. dollar, crude, and interest rates. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always good to be with you, Jim.
Ross, how would you describe what's happening on the stock market this week?
Well, it's run out of steam. For the last 2 weeks, the advanced decline line has been having trouble. It has not managed to eke out new highs along with what we were seeing in the S&P and the NASDAQ. Transports have been having trouble as well, although they had not a bad week this week. In the last, we're not quite closed at this point when we recorded on Friday, but as of today, we've got 5 Hindenburg signals since the 29th of October. Those are interesting in that they identify when the market is really disjointed and you have more than 2.5% new highs and 2.5% new lows. You're in a rising trend, and the McClellan oscillator is giving you signals. And usually when you get 1 or 2 of these Hindenburgs, the odds are that, maybe 20-25% that you'll get a market correction. But when you manage to get 3 or more within 30 days, then the probability goes through to much higher levels. And when you get 5 in a row, or even 4, if that stays as it was as of yesterday's close, very good probability here of a deep correction. Now, on top of that, we've been watching the high yield spread. That's in the bond market. The CCC spread. When you take a look at the Bank of America numbers that are published on the Federal Reserve site, we have been seeing just an improving side of the credit markets there since the March 31st turn. And all the way up in the market, the credit spreads were just slowly improving. We had a few downticks, and then they went back up again. But as of this week, the early part of this week, the CCC spread broke out to a new high for the move. So that's a new high in the spread, which is negative for the equity market. And historically, we get some pretty good corrections when that happens. I think it was like 7 out of 10 had almost immediate corrections. 3 out of 10, this is back since 1999, ended up with rolling tops and eventually working their way lower. So at this point, the credit side of the equation isn't looking that good. And gosh, if we take a look at some of the old leaders, Microsoft, Netflix, Meta, Palantir, they have all rolled over badly. And so the rotational move in the equity markets, has really taken hold here. There's not much that's leading the way on the upside. A few of the oil services, if you look at the OIH ETF, it's managing to move along. But there's not much else that's really looking that healthy right now.
What's going on with gold?
The precious metals, we got the sell signal up there in the first week of April with our upside exhaustion signals in gold and silver. The correction, we bottomed out right on our target level on the 34-day moving average for gold. That was 10 days ago. We put out a signal there letting people know that was probably an interim low. So we've been bouncing around. We've got about $100 trading range right now, but it hasn't got much steam on the upside. Once you get as overbought as we were back in April, you can expect not just one sell-off, but a series of them. So we're bouncing off a first support level, but, I don't think it's going to have a lot of steam. The silver market really has been nice. The upside at 49, right up at the top, was right on in place with the exhaustion signals that we had. The correction bottomed at the same time that gold did, but when we look back, and we've got so this is the 8th time since 1975 that we've had upside exhaustion readings in silver like we saw this year. And once you get the first break, as we've seen now, there's typically a retracement of anywhere from 12 to 15 days. It gets up against a Bollinger Band, and as of today, we're within $1 of that. It's around $49. The price is $48 and change right now. But this one, likewise to gold, probably has got more downside. I think that somewhere around 41 right now looks like a pretty reasonable target for silver in the coming months.
What's happening with crude?
Crude, pretty good bounce this week, but it hasn't had a lot of legs. We got up to 62, back down to 60, and from my perspective, the seasonals still would point to lower moves on the downside. So, until we get excesses, and that typically happens in November through January on the downside, I don't think you want to be looking at the sector too much. There will be better opportunities, and there's always another train to catch.
What's happening with the U.S. and Canadian dollars?
The U.S. dollar's got that really nice double bottom after the downside capitulation that we had back in July. So you double bottomed then against that in September. Moved last week to the highest level since back in May, June. It's gotten a little ahead of itself up here and is due for correction. We got up to just over 100 on the index, then backed off to 99.5 right now. But it's a great-looking double bottom in here, and I would suggest that pullbacks anywhere around 99, 99 and a quarter probably have some decent support. And, on the opposite side, the same signals that say that the dollar was overbought 3 or 4 days ago, we got the reciprocal over on the Canadian dollar and the euro. So we're finally seeing a little bit of a bounce in the Canadian dollar. Nothing to write home about, but, we've come from 70.80 up to 71.10. And you're probably looking at resistance up around 71.60, but clearly the trend is down, and let's not get into politics and budgets, so stay away from that and just stay with the technicals. Trend is down, and you might as well stay with the trend.
And Ross, to celebrate American Thanksgiving, you have a gift.
Yeah, for new subscribers, 25% off for subscriptions, and you'll find that on the website at chartsandmarkets.com.
Ross, thank you so much for chatting with us.
You're welcome.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Jim Rickards next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Jim Rickards. He's the founder of the James Rickards Project and author of many books. His latest is Money GPT, AI and the Threat to the Global Economy. His website, jamesrickardsproject.com. He's on X at Real Jim Rickards. Jim, welcome to This Week in Money.
Thank you. It's great to be with you.
Can you tell us first about your Money GPT book and where our listeners can buy it?
Sure. It came out late last year, just about a year old this month, as a matter of fact. It's called Money GPT, AI and the Threat to the Global Economy. It's obviously about AI. GPT is generative pre-trained transformers. That's a geeky term, but it talks about a new technology that has been used to empower AI to produce, essays and reports and graphics that are extremely well done, to the point that college students don't work anymore. They just go to GPT and get their essays written by the computer. There's a little less there than meets the eye, but that was where the name GPT comes from. But what I do, I'm not bashing AI. AI is powerful. It's everywhere. It's on your dashboard of your car. It's in your refrigerator. My refrigerator tells me to change the water filter. Well, I ignore it, but that's AI, because it has a clock and a humidifier and does all that computation, tells me what to do. But it will have very powerful effects. There'll be some diseases that get cured because of AI. But I was doing a different take on it. I wasn't saying it's here, it's real, it's powerful, so I'll stipulate all of that. But there are a lot of hidden dangers. A lot of things are being ignored. And it's not really about the stock bubble. We are in a bubble. We all know what's going on with NVIDIA and Microsoft, and OpenAI is a private company, but it's got like a $500 billion valuation. They haven't even made any money. So we see the impact of AI on the stock market. It's very clear that that's a bubble, but who knows when it'll break. When it'll break pretty hard, but I'll leave that to others. What I did is looked at how AI is used in the stock market for trading, portfolio allocations, etc., could amplify and accelerate a stock market crash. Crashes have been around forever. Go back to the mid-14th century, 1350, give or take a year. The House of Bardi and the House of Peruzzi in Italy collapsed, caused a European-wide financial panic just a couple of years before the Black Death. So there's nothing to do about that. A lot of that's just human nature. But when you harness AI to the trading system, the decision-making system, outsource your decisions to the AI, you may find that, first of all, the crash happens a lot faster than you think. Secondly, no one can find the kill switch because it's not humans anymore. It's computers making the decision, and they'll just operate faster and on a more deterministic basis. In a normal market, you've got humans, and there'll be bulls and bears and longs and shorts, and people taking different views, and that it doesn't mean panics don't happen. They do, but they're kind of equilibrious. But with computers, they're all programmed the same way, particularly AI, because AI uses what's called a training set, which is materials, basically the whole internet. They have these large language models. They turn the AI programs, algorithms loose on the entire internet. The models compute logical sequences, words that go together. That's how they produce grammatical essays, etc. But when it comes to finance, they're all going to do the same thing, which is what happens when the stock market starts to melt down. What's a good strategy for you individually? Well, a good strategy is sell your stocks, go to cash, move to the sidelines, wait till it's over, and then tiptoe back in at better valuations. That's a really good individual strategy. But it falls prey to something called the logic of a paradox of composition, which means that something that makes sense for an individual is disastrous at scale. So I'll give you a simple example. You're at a baseball game. or for viewers in Canada, a football game, etc. And the person in front of you is particularly tall or wearing a funny hat. You can't see the game very well. So what's the solution? Well, you can stand up, and right away you get a better view. It's like, hey, that works. But then the person behind you stands up, and the person behind her stands up. Next thing you know, the whole stadium's on their feet. Nobody has a better view because relatively you're all the same, but everybody's worse off because you're all standing. That's the technical name for it is the fallacy of composition. But the point being, selling your stocks, going to cash, and waiting out the crash is good for an individual. But what happens when everybody does that? Well, the market goes no bid. Everybody's a seller. Nobody's a buyer. The market goes straight down. You blow through the firewalls, and you literally close the markets. And it's problematic as to whether you can reopen them again. That is what will happen with AI, because if all the AI is programmed the same, there are no humans around to say, oh, maybe it's a good time to buy. Maybe I should buy the dip. Maybe I should step in. No, the computers are all going to do the thing that makes sense for an individual, but in the aggregate, it'll crash the markets. There's a lot more to it than that. I have a chapter on nuclear war fighting. I have a chapter on superintelligence, chapters on bias and censorship. There's a lot there, but I hope readers enjoy it. You can find it on Amazon. It's in bookstores, but Amazon is probably the best way to get it, and they give you a nice discount.
Do you think AI could be the cause of global economic problems or the scapegoat for it?
Both. It will cause global economic problems along the lines I just described. I talked about the stock market in my example, but the same thing could be true in the banking system. Run on the bank. Again, nothing new about runs on the bank. But now, instead of, we've all seen grainy black and white pictures in the 1930s of guys in, overcoats and fedoras hunkered down in the rain, lined up around the block, trying to get the money out of the bank. And of course, it's too late because the insiders already took all the money and the doors are closed. But that kind of thing can happen now much faster. So if I get word that a certain bank is in trouble, this did happen with Silicon Valley Bank, by the way. It was 2023, but it wasn't that long ago. I can take my smartphone, my iPhone or Samsung or whatever, and move the money, hold the phone in my hand, we just with a finger move the money, and then text my best friend and say, hey, get your money out. I just moved mine. That can all happen. You don't need to line up around the block anymore. It can all happen very, very quickly and at scale. These could be $1 million transfers I'm talking about or more. So the point being, it'll exacerbate banking crises, and then I talk about other behavioral aspects of it. So it can definitely be what in the military we call a force multiplier. Again, human nature is the catalyst, but AI is a force multiplier that makes it happen even faster. Now, your second point was a really good one, which is it going to get blamed for things? So right now, we've seen some big layoff announcements from Amazon and Target. IBM did also, but Amazon and Target in particular, because they're oriented to the retail market. It's the Christmas season. They usually hire people during the Christmas season. Why are they laying people off? Well, first of all, that's a very bad economic sign, independent of AI. That's not good if you're firing people in the month before Christmas. But everyone's blaming AI. It's like, Amazon and Target, they've got all these robots and they've got this AI and they don't need the workers anymore. That's nonsense. I mean, they are using AI and they are using more robots, and there will be labor market repercussions from that. But that's all going to take time. But in the short run, right now, what they're doing is they're blaming AI, but when in fact the economy is slowing down, and that's why they're laying people off. So I do think that AI, apart from everything else we just discussed, has become a very convenient scapegoat for things that are actually normal economic cyclical downturns.
Is artificial intelligence just next level programming?
No, it is different. I mean, you can say next level programming is all computer algorithms and code involved, engineering and developers and coding and programming. So that's common to, the computer in general. But it's not just next level. It really is different. And the GPT phenomenon I mentioned, again, generative pre-trained transformer, what that does, it takes computing that used to be done sequentially, like solve this problem, solve the next problem, output becomes input, etc. And it breaks it up into pieces and it allows it to be done in parallel. Now, the pieces converge to a solution at the end, but if you can process in parallel instead of sequentially, you can do more faster. That's why the chip side of it's so important, because you do need these super fast, particularly NVIDIA, but AMD and a few others make them, but these super fast NVIDIA chips to be able to utilize GPT. And then the other element is the internet, because the training sets are bigger. I mean, it's one thing to scan in the pages of, Charles Dickens or Shakespeare or something, but when you've got basically all the knowledge in the history of the world digitized in the internet somewhere, it's out there somewhere. So you've got a bigger pool of information. You've got faster processing, and you've got large language models and the GPT technology that enables you to not just process faster in terms of the chips, but also in terms of the logical sequences. So it is different, and it's powerful. That doesn't mean it's flawless. In fact, there are tons of flaws, but it is different.
There's a push to control, censor, and surveil the people of the world. Is AI being used to make this happen, and could different AI be used to put a stop to it?
Yes and maybe. So the first one, and this is what Palantir does. I remember around 2001, 2002, Admiral John Poindexter proposed a system called Total Information Awareness, TIA. It means ant in Spanish, but anyway, he said, let's get all the data we can, all the computer power we can, keep tabs on everybody, profile terrorists. So it was after 9/11. There was a reason for it, but his program was Total Information Awareness, and it got rejected very quickly. Everyone's like, "Oh, we don't want that. You'll put the good guys under surveillance. How are you going to profile and all that?" So it was kind of rejected, at least superficially. But here we are. I mean, I'm not dinging Palantir as a great company, but what Palantir does is Total Information Awareness. Now, this plays into central bank digital currencies, Chinese social credit scores. This is going on all over the world. Britain has, Prime Minister Starmer has proposed a digital ID card for all members, all subjects in the UK. Now, they always do this. They always sell it on the basis of convenience and security. Central bank digital currencies will make your transactions faster and cheaper, more reliable. A digital ID card will, open the door to, any, sporting venues or voting or whatever you want to use. And, it's always sold on the basis of convenience and speed and cost. And some of those claims are valid. These things can be better, faster, cheaper. But what they don't tell you is that they're gathering all the information. They can process it just along the lines I described earlier, talking about what GPT is, and keep tabs on everybody. And they, then they use it for marketing reasons. You just, you mentioned, gee, I'd like to go to Trinidad on vacation, and then you go to your internet browser and there's 5 ads for Trinidad vacation. It's like, gee, how did the computer know I was thinking about taking a vacation in Trinidad? Well, it's because it was listening to you. Your iPhone is listening to you. You're being wiretapped, filmed, surveyed, monitored, position located all the time, whether you know it or not. Now, does that information allow advertisers and marketers to target the audience and, don't send me, a certain kind of commercial because I don't drink a lot of beer, so don't hit me with a beer commercial, but hit me with something else. Yeah, they do use it for that, but it's also used for, as we've seen with the weaponization of the FBI and abuse of power by the Biden administration, they targeted basically half the Republicans in the Senate under this Operation Arctic Frost, and they came up with phony charges against Donald Trump to the point of impeachment with Operation Crossfire Hurricane. So the kind of technology we're talking about, combined with abuse of power, absolutely makes everyone a target and enables not just government surveillance, but profiling and actually start to disadvantage you, put you on a watch list. Or in China, I mean, if you say anything against the party, you'll quickly find that you can't buy a plane ticket, you can't buy a train ticket, your kids will not get into college, et cetera. That you will be socially crushed because you had remarks or wrote a paper or gave a speech or whatever that was not in line with the Communist Party ideology. And then it can get worse than that. They can arrest you and take your organs out without anesthetic because you're a political enemy, and then you die. So So yes, that is going on. It is enabled by AI and the powerful chips. Palantir is a leader in around the world, but it's a U.S.-based company, but there are others doing it as well. Now, the second part of your question is, can we use AI to fight back? I think that capacity is limited. You could have in theory, a cyber war, but do everyday people have access to that kind of technology? Do they know how to use it? Do they know how to fight back? Some do, but most don't. But there is a lot you can do. You can use Faraday bags. A Faraday bag is let's say it can be a pouch or briefcase or, just a sack or whatever, but it's lined with certain metallic fibers that cut radio transmission. So if your phone is, if they're tracking you with your phone, turning your phone off is not good enough, but turn your phone off, put it in a Faraday bag, and now it goes dark. The government can't track that. Use cash instead of credit cards. I worked with programs with the CIA where the questions, could you track a terrorist using their credit card purchases, assuming they don't have a cell phone and they're smart enough not to do that? Could you track that with credit card? The answer is yes. It's a lot to it, but you can do that. So use cash, put your cell phone in a Faraday sack, take down your Easy Pass transponders, stay off highways with toll booths, take local roads, use a bicycle. There's just a whole bunch of things that individuals can do to go off grid, either completely if you have a farm somewhere, or in certain dimensions with your cell phone in your car. Drive an old car, get a 15-year-old car because it doesn't have all this electronics in it. A modern car, again, I said put your cell phone in a Faraday sack. Yeah, but your car is one big, transmitter. They're tracking your car. And they're using, the toll booths are monitoring stations. They read your license plates. You can take your front license plate off depending on the state. And the back license plate, there are these plastic shields that, in theory, someone close up can read the license plate, but the cameras can. It kind of blurs it for the camera. So there are a large number of strategies that individuals can adopt to minimize tracking and minimize your footprint on the grid, the internet grid, if you will, the surveillance grid, that are helpful. Don't fool yourself and think you're 100% off the grid, but getting 90% off the grid is pretty good. They're going to probably go look at somebody else.
I think you've answered this question. Are there ways to drastically reduce or eliminate control, censorship, and surveillance?
Surveillance in particular, control and censorship, it depends. That's actually more difficult because, let me step back. Meta, which, basically Facebook and Google, have used completely fascist censorship techniques because they control so many channels. Those two companies together control, we say, okay, Facebook is what it is and Google search engine, but they own YouTube, Instagram, WhatsApp. They own a lot of different channels that people rely on, whether people may not realize that they're all owned by Meta and Google, which is one thing, by the way, the government could do is use the antitrust laws to break them up, but I'm not holding my breath for that. But so they can deplatform you. I've seen examples of that. I did an interview with a good friend of mine who had a YouTube channel in Australia, and she used it for marketing purposes. I was happy to do an interview. It was content for her. But I said things like, this is back during the COVID days. I said, the vaccines are a joke. They're killing more people they're not saving anyone. They're killing people, and the masks don't work. And 6-foot social distancing came up with, the guy who came up with it was a late 19th century German scientist who later admitted he didn't know what he was talking about. The entire lockdown, D.A. Henderson, greatest immunologist, the man given credit for eradicating smallpox on the planet Earth, he wrote a paper in 2006 that said lockdowns don't work. He explained why. So everything we were told during the pandemic was a lie. Social distancing doesn't work with an airborne respiratory virus. Masks don't work because the virus is smaller than the weave of the mask. Lockdowns don't work. They destroy the economy very effectively, but they don't work to stop the disease. The virus goes where it wants to go. And the vaccines are not really vaccines; they're experimental gene modification therapies. So I said, and it's all true, by the way. There's documentary evidence. I wrote a book on that, by the way. It's a best-selling book on COVID called The New Great Depression. It came out in 2021. So all this was clear, 5-6 years ago. I mean, you hear more about it today, but it was clear at the time. But my point is, my friend's YouTube channel was taken down because of what I said. I had to call her and say, sorry, but and she got reinstated. But yeah, that kind of censorship was, and there were many worse examples. That was one I happen to be personally acquainted with. So yeah, they're fascist censors. They do what the government tells them. That's the bad news. The good news is there are almost no barriers to entry to start your own podcast, and there are channels like Getter, Rumble. Twitter used to be fascist censorship, but with Elon Musk, it's a lot more free. So, Breitbart News and others. So there are a lot of channels out there where you can get good information, but if you're on them, if you're a guest or an interview subject or a host or whatever, or even start your own podcast, it's not hard to do. But don't rely on YouTube and Instagram and to get your message out, because they're heavily censored.
What are the countries with the most freedom, and are they likely to remain that way?
Well, I like Antarctica. I was there recently, and there's no government at all. So I thought that was good. There's a treaty where countries agree to do or not do certain things, but like I say, it's a treaty. It's an agreement among the countries, but there's no government at all. The closest thing to a government is the cruise vessel operators. Meet. They try to space out the cruise ship schedules, not have more than one in a certain harbor, certain inlet, not really harbors because there's no structures down there, but certain inlet at a certain time. But I like Antarctica. That's my model, because there's no government at all. Beyond that, sometimes you find, I would say the United States is getting less free. I would say the UK is kind of looking like the old, East Germany during the Cold War. I mean, the censorship, you get arrested for saying the wrong thing. The UK is very, very close to fascism. France and Germany are a little better. For freedom, it's hard to know. There are places, I just got back from Slovenia. Very beautiful country, small population, 2 million people, fairly homogeneous, very peaceful, very prosperous. I met with some government officials. My advice to them was quit NATO, quit the EU, get out of the ECB, bag the euro, start your own currency, and put half your reserves in gold. People came up to me after the presentation. That's the kind of thing that would get you arrested in the UK these days, but people came up to me after the presentation. They said, "Thank you for saying what you said. We agree. Our government doesn't agree, but that a lot of us are thinking the same way." So a lot of countries that are maybe not as well known off the run, and Slovenia, like I say, it's a very, very small country, but I found that it was a breath of fresh air. I really liked the people, and I thought the government was doing a lot of things right. And then sometimes there are places where they might even have a socialist government, but socialists are so bad at what they do. In a perverse way, you kind of get freedom because they want to control you, but they're bad at it, so you end up not having much control. I mean, that's paradoxical, but that kind of exists. Pick your spots. But I would put. I was in Bosnia. Again, people were very nice. I really enjoyed my time there. So I think Europe is moving pretty quickly towards fascism. Portugal might be okay, but France, Germany, UK, Poland, partly because of the war in Ukraine, but they're all moving towards fascism. The U.S., we were very far down that road with Biden, Biden and Zuckerberg and Google, censoring the kinds of things we talked about already. Trump has stopped some of that, but it takes a while to erase it. You can't clean up the deep state in 6 months, although they're trying. So things are probably getting a little better in the U.S. Canada is very fascist. Australia, I mean, what they did in Victoria during COVID, they had concentration camps. I mean, they weren't death camps. I guess some people died, but they weren't death camps, but they were concentration camps where they rounded people up and put them in these, COVID COVID concentrations where you were not allowed out in the general population. It doesn't do any good. It doesn't stop the virus, but it is purely fascist, bordering totalitarian. So I would say freedom is very much on the decline, very much in jeopardy in places that are supposedly free, like Canada, Australia, New Zealand, the UK, Ireland's getting that way, and the United States is much better. But there are countries that have a Cold War legacy, but have actually broken out, and where I think freedom is, you can feel it, and I would put Slovenia and Bosnia in that category.
The World Economic Forum slogan is, "You'll own nothing and be happy." Most wealth is in real estate and financial instruments. How could people go from owning all this wealth to owning nothing?
Well, Karl Marx wrote thousands of pages. I mean, lots of research. A lot of people, I'm going to say most people, at least with a college education, read the Communist Manifesto, which is, it's a pamphlet. I mean, it's about 100 pages. It's easy to get through. But if Capital, good luck. That's 2 volumes, over 1,000 pages, much more dense, and other writings as well. But someone asked Marx, he said, you've written thousands and thousands of pages on communism. He said, can you boil it down to one sentence? And he said, well, if I had to boil it down to one, sentence or phrase, communism is the abolition of private property. The abolition of private property. Now, think about the World Economic Forum. You will own nothing. What does that mean? Well, that is the abolition of private property, because you don't own anything. So it's communist. I don't think we need to belabor it. That's just who they are.
Going forward, where do you think the safest places will be to store wealth?
Well, it depends on what kind of wealth. I mean, if it's real estate, then it is wherever it is. You might want to pick your spots or pick your jurisdictions. I wouldn't count on owning real estate in China or a lot of other places. But at least the rule of law in the U.S. is still pretty good, and it tends to vary state by state, although they can tax you out of existence. So I watch out for property taxes. But real estate, by definition, is wherever it is. Same thing with physical gold. Now, you do have storage issues. The worst place to put gold is in the bank safe deposit box, because that's the first place they'll look. If they want to come and get it, they'll just open all the safe deposit boxes and take all the gold. So you want either private storage, and you got to. If you say I want to go overseas with that, you have a different issue. I think. Well, I know a lot of Russians and others store gold in Dubai. I know where the gold vaults are there. A lot of people like Singapore, they store their gold there. Switzerland, of course. The problem with all of those is they can be relatively safe jurisdictions, but how are you going to get there? Like, when you want the gold, how are you going to get there? So if the world's falling apart, are you going to be able to fuel your private jet? Is the pilot going to want to fly you there if he has to leave his family behind? I mean, people who think they're good at catastrophe planning actually don't think a lot of things through to like I say, the practicalities of how you get your gold in that scenario. One thing I have noticed, by the way, I've been to a lot of gold vaults around the world. They're all next to airports. They're all really close to airports, small airports in some cases, where you can, in theory, fly your private plane in and get your gold and fly out all pretty quickly. So keep it out of the banks. There are some reputable private storage companies, Brinks, Loomis, a few others. I'm not, endorsing anybody, but I happen to know they're pretty good companies. But the best security is just, put it in a safe place and don't tell anyone you have it.
Are small banks starting to collapse, and should we be concerned?
Small banks are fine. I actually keep a lot of money in a small bank. That was started in 1877. I was like, okay, you survived the panic of 1893, 1898, 1907, 1929, the Great Depression, and a lot else in 2008. So you must be doing something right. So I think small banks, if you're careful, are fine. The big banks are too big to fail. Now, there are different ways to lose money in banks. Most people, you're worried about losing your deposits. And I think the too big to fail banks, they'll prop that up. Deposit insurance is $250,000, but that's per individual, per account. So a husband and wife, for example, could have two accounts. An IRA would be a third account that's separate. There's more than one bank. So husband and wife together could open two accounts each at three different banks, and now you've got six accounts. But that is, now you're up to $1.5 million, or so. And so, you can actually get a lot of money insured by FDIC by using multiple banks and multiple accounts. But, some you have more than that. Some individuals do, a lot of businesses do. The small banks are probably the best. The big banks are too big to fail. The danger is the mid-sized banks. And mid-size I would define as between 100 billion and 900 billion in deposits. So you're not in the kind of multi-trillion-dollar category, but you're not a small bank either. But you're not big enough to be too big to fail, but you are big enough to fail. Meaning, you don't have the financial controls, et cetera, and risk management, and you are vulnerable to a run on the bank. You don't have the confidence of your investors, et cetera. So I would look for banks in that kind of 100 billion to 900 billion total asset range. And one of the indicators I look at is, and it's very easy to compute. All this information is publicly available. Compute the ratio of insured deposits to total deposits. And the higher the ratio, the safer the bank. But take Silicon Valley Bank, for example. The ratio is 3%. Only 3% of the deposits in Silicon Valley Bank were insured. 97% were uninsured because they were over the FDIC insurance limit. That bank could fail in a heartbeat because people who are not insured are going to get their money out fast, and they did. And then the government had to come in, and they ended up insuring everybody whether they were within the limits or not. They basically blew off the FDIC insurance limit and guaranteed everybody because they had no other way to stop the crisis. But if you want to know whether a bank is going to suffer a run on the bank in the first place, look at the ratio of insured to total. If it's 60 or 70%, that's a pretty safe bank. If it's 10%, it's a very risky bank.
Could artificial intelligence be programmed to keep you from your wealth?
Sure. You don't need artificial intelligence. You just need a phone call and freeze the assets. This is the problem with digital wealth. It's you can freeze it with a phone call or a few keystrokes. So the wealth that's harder to steal is physical gold. If it's not in the banks, land, obviously silver. I would say the same thing. Fine art, cash, meaning cash like bills, not in the bank, but any kind of digital wealth. With or without artificial intelligence. Artificial intelligence would be used to profile you and track you. And then, like I say, a phone call or keystrokes are enough to freeze the assets.
On one hand, technology is our friend. On the other hand, our foe. What are your thoughts on the good and the bad of technology, and especially AI? Well, there's something called the law of conservation of information in search. Not very well known, but one of the author of a paper on that topic, peer reviewed, is a collaborator of mine. We work together on other projects, and he has a very rigorous mathematical proof of the proposition. And what it says is that it doesn't matter how fast your chips are. It doesn't matter how good your artificial intelligence is. You will never find anything new. Can AI search faster? Yes. Can it search more broadly? Yes. But whatever it comes back with is already there. It cannot come up with any new information. But so where does new information come from? Well, it comes from humans, through creativity. Musicians, artists, writers, mathematicians. It doesn't have to be, art. It can be science. But my point being, humans create new information. Computers don't. They can find it faster, but they can't create it. So that's one of the limitations in AI that people don't appreciate. It will, as I say, search gets faster and broader, and it will come up with things that humans couldn't come up with in any reasonable period of time. But it doesn't mean it's not already there. It's not really creative. Are Bitcoin and other cryptos products of AI?
No, they're actually pretty crude. The blockchain's been around since the late 70s, early 80s. The mathematical formula for Bitcoin and Bitcoin mining was original, but it's very limited. People say, I have an anonymity on the blockchain. Well, not really, because the blockchain, anyone looking at the blockchain can tell whether a set of transactions were by the same party or not. You may not know the name of that party, so you have that kind of anonymity. But based on the code, you can see that it was the same party, for example, in one or more transactions. And based on that, we know that over 90% of all the Bitcoin transactions are conducted by fewer than 5% of the Bitcoin holders. In other words, there's a small group of so-called whales with enormous amounts of Bitcoin who are conducting the vast majority of the transactions. And everyone else is kind of a sucker, being brought along in the game. You just paint the tape. It's the kind of thing if you did in the stock market, you'd be in jail. But in the crypto market, it's not regulated. But none of what I just described, and there's a lot more to say on that, but none of that has anything to do with AI. So I would say it's not that you couldn't use AI to manipulate the market, but it's already being manipulated in good old-fashioned ways.
Gold has had a hell of a run. Do you think gold has just put in a short-term or long-term top?
No, it's not. It's nowhere near close to a top. It'll get to 10,000 a lot faster than people expect. I would expect it to go much higher than that, but 10,000, we're right at 4,000 today as we're speaking. 10,000 seems really far away. It's like, it took a long time to get from 2,000 to 3,000. With 4, all right, but it's going to take a really long time to get to 10. It won't. It's going to happen much faster than people think. And this is really enjoyed this interview. It's been great talking to you.
Silver also had a hell of a run, finally to new all-time highs. Does it look like silver has just put in short-term or long-term tops?
No, silver will tag along with gold. It tags along with a lag, and silver is more difficult to analyze. But the issue is because silver is a precious metal, as is gold, but gold does not have very many industrial outputs, almost none. Silver does in catalytic converters, electronics, and a lot else. So with silver, you have to analyze it as a precious metal that pulls in one direction, but as industrial output, it could be pulling in the opposite direction if manufacturing is slowing down, which it is. So, but having said that, there's no way that gold is going to 10,000, but silver won't go to 200. It might lag a little bit, but it's along for the ride.
Palladium and platinum have had great moves. Is it looking like they have put in short-term or long-term tops?
Yeah, I don't know anything about palladium and platinum. I don't really cover them at all. And I do have to go, so it's been great talking to you.
Well, thank you so much for being on our show. Jim, again, can you remind people where they can get your new book?
Thank you. The book is called Money GPT, AI and the Threat to the Global Economy. It's available on Amazon and at good bookstores. And my X account is at Real Jim Rickards. So hope people enjoy the book. And thank you. It's been great being with you.
Thank you. My guest has been Jim Rickards, founder of the James Rickards Projects and the author of many books. His latest book is Money GPT, AI and the Threat to the Global Economy. Coming up, Victor Adair, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in British Columbia, but still very active in the markets. His website, VictorAdair.ca. He's speaking to us from Parksville on Vancouver Island. Welcome back to This Week in Money.
Well, Jim, it's always a pleasure to talk with you. Thank you.
Before we discuss individual markets, it seems the big story this week was the dramatic sentiment change around big cap tech. Do you agree?
Yeah, I think that was absolutely the big story of the week. Just for background, the leading equity markets, let's just say the S&P and the NASDAQ, were making new all-time highs in February of this year. They had a hell of a sell-off in April on Donald Trump's announcements. They called it Liberation Day, as he explained how much he was going to try to extort other countries around the world, with tariffs and so on. But since then, we had the S&P, I guess, rallied about 40% off the lows in April. The NASDAQ was up more like 60%, and it was just an amazing rally. I mean, the traditional metrics that we use to, say, measure valuations in the stock market were stretched, to be polite. A lot of them were like there was even a term going around to the effect of, it doesn't matter. You can't use yesterday's measuring stick for the brave new world that we're in. So, okay, if you want to look at it that way. But certainly we had concentration. In other words, the top 10 stocks in the S&P sort of were the S&P. They were certainly 40% of the market cap. And speaking of market cap, I mean, this is just to put some perspective in it. NVIDIA became the world's largest company by market cap. And here, 10 days or so ago, whatever it was, when they were at their zenith, the market cap was about $5 trillion. Now, to put that in perspective, that is more than twice the annual GDP for Canada as a whole. Like, add everybody in this country that's working and doing whatever they're doing, add up the value of all that, and NVIDIA was worth twice as much. So, last week in my trading desk notes, I asked a question, basically. It was sort of, are we seeing in big cap tech right now something similar to what we had in the oil patch? I'm going to say go back to 2014, 15, thereabouts, when the term was drill, baby, drill. Okay, so what that meant in the oil patch was that drillers are going to drill. That's what they do. And they're going to keep drilling no matter what the price of oil is, because the more they drill, the more oil they're going to find, and everything's going to be better. So it seems with the big cap tech companies, they were going to just spend enormous sums of money building data centers, rolling these things out. And I'd say my questioning was, and I'm reading a lot of other people as well, there just seemed to be a bit of an undercurrent started about 2 weeks ago about whether or not there was really going to be a return on investment from all of this money that was being spent. And then, then the questions really started to come. But that was sort of the thing that started it. I can't even remember to list all of the other things that have happened, but I think we have to have, one idea, for instance, is will there be enough electricity if they build these things? Enough electricity not only for the data centers, but for everything else, to plug in your electric car, to turn the lights on so you can see what you're doing at home, and on and on and on. And I think you say, well, yeah, they just build new stuff. Well, but you look at the time lag between when you say order a new gas turbine to use natural gas to create electricity and the time that it's like 4, maybe 8 years down the road before you actually get it. So there's been a lot of questioning as to whether or not the valuations of these companies that were spending enormous sums on AI build-outs, whether or not the valuations were good. And, we've seen the NASDAQ, let's say from last week's highs to this week's lows, came off about 6%. Now, 6% is nothing, really, compared to the 60% growth we've had since April. But I think this is this story about, maybe we need to do a re-examination of the valuations on these big cap stocks. I think that is absolutely, been the big story of the week. Now, one other thing occurs to me while I'm on a roll here. You remember back in January, we had something called DeepSeek, and that just pulled the rug out from under the market, in that it seemed like there was a couple of guys in a garage in Beijing somewhere that came up with an AI package that was a fraction of the cost of what the American companies were building. So you have to think that with all of this believing that things are just so good, that there had to be some rationale, I guess, for some questioning, and we certainly had that. And I think the backup in the AI issues this week have kind of given us weakness across the board in the equity markets.
The S&P 500, the NASDAQ were trading at all-time highs in February, but fell to 12-month lows in April following Trump's tariff announcements. Since those lows, the S&P's rallied about 40% to October's highs, the NASDAQ over 60%. During the rally, it seemed as though buy every dip was an excellent trading strategy. Do you think that's still the case?
Well, no. Sorry, Jimmy. Yeah, but it was. It truly was. I mean, I know. I mean, I've just been trading for 50 years, so I think you get pretty jaded. You just see so much stuff over a period of time. You just don't believe anything anymore. But, yeah, I mean, people were buying the dip, and the market would just go higher, and the more you bought the dip and got rewarded, the more you wanted to do it. But I'm not sure that it's over. That's for sure. I mean, this CapEx spending is going to continue. They're going to borrow more and more money to do it, and I even saw this week there was some talk about maybe the government would, that's the American government, would sort of guarantee some of the loans and all that sort of thing, that in effect that the big cap tech companies were going to be too big to fail, like the Wall Street banks were too big to fail when we had the previous sharp downturns in the market. Buying a dip, there's an old saying that the trend is your friend. And honestly, over the years, I have to say that is a powerful thing. And if you have a market that's trending higher and it has a little setback, and you buy that setback, that's buying the dip, you kind of got a tailwind, as it were, behind you, giving you some extra advantage. So buying a dip in that respect, made some sense. But buying a dip when a market is sort of already goofy overvalued, but again, we're not supposed to use those traditional metrics anymore. Anyway, I don't like to do that, but everybody's got to make their own choices, I guess.
Gold rose over $1,000 from mid-August to mid-October, and the rally in silver was even more dramatic. What are your thoughts on the precious metals?
Well, that's a good time to ask that, because I think what we saw happen in gold, as you say, it jumped $1,000 in 2 months. And that was a case of, certainly, there was a strong underlying rationale to be buying gold, whether you're a central bank or, somebody going into Walmart and getting a tiny little sliver of the stuff. But the market just got goofy overvalued and was running away. And I know I was writing at that time, I was saying, gold is not going up on that, call it the debasement notion that was going around. This is going up by it's momentum. People are buying this because it's going up. It doesn't matter what the hell it is, what stock symbol it is. If the thing is racing to the upside, there's a certain crowd out there that just has to buy it. Well, we saw what happened to gold. I mean, it had that explosive run to the upside, silver even more so, and then a very sharp correction coming back from that. So, I absolutely still think there's a fundamental bullish case for gold as an alternative to some of the craziness that there is in the world. But I think that it's probably got to settle down here a little bit. Unless you're just buying it and you're saying, I'm going to buy it, put it away, and not even look at it. But, it's hard to do. I know people that are long-term holders of gold, and they're checking the price 12 times a day. So when you're into something, sometimes it's hard to leave it alone.
The U.S. dollar index fell about 13% in the first half of the year, but has rallied back by about 4% over the last couple of months. What are you doing in the currency markets?
I've been doing relatively little compared to what I do historically. I mean, if there was only one market I could trade, it would be the currency markets, because that's sort of been my thing for the past, I guess it's 45 years or more. But one of the things I'm focused on is the yen. And the yen is very low relative to the U.S. dollar. It fell about 50% from all-time highs in 2012 to the lows we made in July of last year, 2024. The yen is at all-time lows against the euro currency. And then we have a new prime minister, as everybody probably knows, in Japan. She was a protege of Abe, and people are expecting her to do sort of like be, the reincarnation, as it were, of Abe. Whether or not that's true, I don't know. But I just see it as, I think there's a rationale that could be made that we're going to see money repatriated to Japan. Over the past few decades, actually, Japanese people and companies have invested outside of Japan where they could get better returns than staying at home. And this is a very long-term kind of a thing, so don't expect it to happen tomorrow. But if indeed this new prime minister ushers in a new era, say, in Japan, we might see money flow, Japanese money that's invested outside of Japan, come back to Japan, which will put a bid in the yen. The Japanese central bank is very slowly raising interest rates while everybody else is lowering interest rates. So that was one of the reasons to be invested outside of Japan, because interest rates were way lower there. So that's reversing. And I just think there may be some opportunities in the yen, but I have to say, I've lost money here the past 2 months or so, making bets on the yen to see that it would rise against the U.S. dollar. And I'm, as I say, intrigued with buying the yen against the euro. Other than that, the Canadian dollar has been a dog. I have been happily positioned in U.S. dollars instead of in Canadian dollars, and that's worked out for me recently. When I look at either the euro or the British pound, I just want to short them just on the basis of their brain-dead energy policies alone. So there's that. The Swiss franc just continues to be the strongest currency in the world. It's amazing, that they don't price themselves out of the market in terms of being able to export things. But and the Swiss franc is a minor currency. I'll trade that from time to time, and mostly if I'm trading the Swiss franc, I'll be trading it against the euro. So if I like the picture of somebody in Europe who's got some savings and they're looking around at the policies in their local governments and they say, something, I think I got to put some money into Switzerland where it'll be safe from my local politicians getting their hands on it. But Jimmy, typically I'd be much more active in currencies, but lately currencies have been kind of dead for me, so I'm doing trading other markets.
WTI oil prices are around $60 a barrel, which seems too low for many producers. Why is the price so low, and do you think it will rally?
Oil is a real classic supply-demand story. I believe in the short run here, and let's call it, that's sort of month to month, that kind of a time frame, the market is oversupplied with crude relative to what the demand is out there. We've seen, for instance, the United States is producing more hydrocarbons, I like to use that word instead of fossil fuels, than ever before. They're a net exporter. Canada keeps increasing their production. OPEC has been increasing their production, I think, by about, if you go back 12 months, they've increased their production by about, or their production quotas, I should say, by about 2 million barrels a day. And, as much as Europe or the United States tries to block Russia from exporting oil, to punish them for invading Ukraine or to get them, to the point where they can't afford to run the war anymore. As much as they try to do that, it doesn't work. Sanctions on oil, I've traded oil for 50 years, and sanctions just don't work, really. Now, certainly to some degree at some level they'll work. If you're Iran and the only way you can get oil, out of the country is by ship, then that's easier to control. The Russians have all kinds of ways to move their oil. So I think the short answer to your question is lately the oil market is oversupplied. China has been building up their version of the strategic oil reserve. America is doing very, very marginal bit of that. But there's just more oil being produced, whether it's off the coast of South America or other places. Now, that's very short term. I pay a lot of attention to Joseph Schachter, and I know Joseph is one of your guests. I attend all of his conferences here over the last 8 years or so, and I understand Joseph sees oil prices much higher next year, and certainly over the next few years, as those parts of the world that are what we would consider really poor now will become more prosperous and will demand and will take more energy. So I could see oil prices going higher on that time frame. But right here between now and next week, I'm on the short side of oil. I just think it's oversupplied.
Many central banks around the world, including Canada and the U.S., have been cutting interest rates. It seems, at least in North America, that the banks are more concerned about weaker employment than keeping inflation in check. Would you agree?
I would. I'm not sure that that's the right thing, but one of my mantras, I guess, when it comes to trading is to, trade what you see in the market rather than what you think should be going on. I think this inflation problem, and some people will say it's not even a problem, but I think it is, and I think the way I look at inflation is that people understand that the things that they need to buy or that they want to buy are going up a lot more in price than what the CPI is. And one of the reasons for that is, and it seems that we're going to go more and more this way, is that we not only have a stimulative fiscal policy where the government is going to spend money, but we've got a stimulative monetary policy with the central banks lowering interest rates as well. Now, they call that run it hot. I understand that, in that, the idea would be there's so much debt outstanding and the interest on that debt just keeps going up. So we got to do something. And the idea of get the economy going hotter, that's the nominal economy, so that you can generate more income and pay down the debt and, everybody comes out smiling. I guess that's the plan. But to me, the very root of what is inflation is that there's more and more money in circulation, and that means that the purchasing power of the money goes down, supply demand, and that's what inflation is all about. So, another way of saying it, and this is sort of sarcastic, but the central banks kind of collectively came up with this idea of, well, if we can keep inflation at around 2% annually, we can live with that. That's okay. Well, I would say that 3% or higher is now the new 2%, but none of the central banks are going to own up to that. So, do I agree that they're not worried about inflation? Yeah, I agree with that. There's different ways, I guess, of looking at the unemployment side. I mean, if you consider artificial intelligence, it seems as though that's already taking jobs, and you'll hear anecdotal evidence of, we won't need lawyers anymore. You'd just be able to ask, Google a question. So, I don't know. The world is changing for sure, and when the world changes, there's opportunities for some people and problems for other people. I guess that's just how it is. But, yeah, right now, the central banks are cutting interest rates. It's, in some respects, you say, the stock market's at all-time highs. Is this a good time to be cutting interest rates and, in effect, goosing the economy even more? Traditionally, you'd say no, but again, you trade the market the way it is, not the way you think it should be.
Before we wrap up, I noticed a comment on the trading desk notes you posted last week. You wrote that too much leverage is the Achilles heel of the market. Would you like to expand on that?
Yeah, I guess I did just a little bit right a moment ago, but that is, how can I go at this? I'll start with just from individual traders. I've just seen a lot of people lose a lot of money in their trading over the years. I was a broker for 45 years, and one of the most common mistakes people would make is when they just use too much leverage. If you can put up $1 and make 10, it'd be really more exciting if you could put up $1 and make 20. And, if that works for you once or twice, then maybe you think you're a genius and away you go. But there's too much leverage everywhere. I just got done talking about fiscal stimulus and monetary stimulus. That's all leverage. If you put a couple of sticks of firewood in the stove, that'll ramp up the temperature for sure and, produce more results. I just think at a very granular level, we've seen the rise of levered ETFs. Okay, you want to buy a share of stock, you can pay $1 and get $1's worth of stock. You want to borrow some money from your broker, and it's a good stock, you pay 50 cents and you get the price action on $1's worth of stock. You want to trade futures, you multiply the leverage, it just gets up and up. But the popularity of people buying ETFs that are leveraged so they get more bang for their buck. I've watched these charts. They've just gone off the top of the charts. There's too much leverage everywhere, and that just leaves the markets, I guess, vulnerable. If you're highly levered on something and the price goes down, either you sell it or the margin clerk blows you out. That's how it works. The brokerage house doesn't want to go down because of your losses. So when we have too much leverage, the market becomes extra vulnerable to a setback. Now, maybe just put the other side on that. It's been my observation in my life when I look around that I've had and known some people who've made an extraordinary amount of money relative to other people. And virtually everybody that I can think of that's made a lot of money has used a lot of leverage. Now, the most common way to do that people understand is with real estate. You buy some property, you put 10% down, and you mortgage 90%. And when you're in a bullish market on real estate and your banker will lend you millions and millions of dollars, believe me, you can make $1 billion. And, that's how folks have done it. And that's just great. And it would kind of say to other people, if you want to make money, you got to use leverage. Well, yeah, I guess you do, but I think there's leverage, and then there's too much leverage, and you never really find out whether it's too much until it's too late. Anyway, you got to be careful with leverage, Jimmy.
Like how much water do you put into your bilge on your boat?
Yeah, stuff like that.
A little's good, but you can't have too much. Victor, what's the best way for people to get a hold of you if they have more questions?
Well, they can go to my website, which is Adair.Ca, and I post my trading desk notes up there. And I guess they could send an email to Victor@Adair.Ca. But anyway, that's how to send me an email. I'd say go and look at my website. And the other thing about my website, there's the archive there goes back 5 years of weekly notes. And one of the things I use the archive for, I'll be looking at a chart and something happened 3 years ago, and I think, what the hell was going on there that caused that? And I just go look at my notes and go, oh yeah, that's what it was. So there is some value to the archive there going back 5 years.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure to be with you. Thank you kindly for having me on.
My guest has been Victor Adair, and as you just heard, that's how you get a hold of him, going to VictorAdair.ca. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Jim Rickards, and Victor Adair, and thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.